The 5th of April is coming up, and with it, the end of the UK tax year. You may have heard people use the phrase tax planning, but not really understand what that means or how to go about it yourself. The end of the tax year is one of those dates that quietly slips past most people, and unlike a lot of financial deadlines, missing this one doesn't automatically send you a letter or charge you a fine. It just means you've permanently lost access to some allowances and reliefs that could have saved you or made you some real money. If you haven't thought about your tax position for this year, then now is the time to do it. So in this video, we're going to walk through a number of the options, why they are worth acting on, and what the best moves look like for your situation. But who is tax planning for? Before we get into the detail, let's be honest about who tax planning actually applies to, because it's probably more people than you might think. One group is people with variable income, freelancers, contractors, or anyone who's had an unusual year, a bonus, a big sale. If your income has been higher than normal this year, you've got more reason than ever to act before April 5th. Then there are high earners. We're going to talk about some specific income thresholds later on, where the tax system gets quite interesting. If you earn over £50,000 or over £100,000, you want to pay close attention here. And for the people who are near those boundaries especially, maybe just a little over a threshold that's costing them a benefit, or just under one that's not quite helping them out. Small adjustments in these places can have outsized effects. Then there are the people who have some spare cash. We've all heard the expression, you need to spend money to make money. Well, in tax planning, sometimes you have to put money somewhere, either into a pension or an ISA, in order to save it from the taxman, or to solve one of those boundary issues. It's not spending in the traditional sense, the money is still yours, but it does require you to be willing to commit it, sometimes in ways that will lock it up for years, or even decades before you can get it back into your hands. And finally, people with inefficient holdings, where investments sitting in general trading accounts that could be inside a tax-efficient pension or ISA, gains that could be crystallised and rebased, assets that could be better positioned. Sometimes tax planning isn't about putting new money in, it's about tidying up what you have to reap the benefits in future years. So what are we going to cover today? Firstly, we'll go through the various options available to you, pensions, ISAs, business planning tools, some more specialist vehicles, and a few things that don't cost you anything but attention. Then we'll look at the reasons to act, because knowing what's available isn't enough. You need to know why it's worth doing and what it's actually saving you. It is a whistle-stop tour, and some elements may require further thought or professional consultation before taking any action, so please do not treat this as advice or even an exhaustive list. Let's get into it. What options are there? Let's start with pensions, because for most people, this is the single most powerful tax planning tool available. So what actually is a pension? There are two sorts of pensions, broadly speaking. There are defined benefit and defined contribution pensions. For today, we're looking only at defined contribution pensions. A pension is, at its core, a tax-privileged savings wrapper. The defining feature is that contributions go in before tax, or rather, tax relief is applied on the way in, and the money is taxed on the way out when you draw it as income in retirement. What that means in practice is, if you are a basic rate taxpayer, a £100 contribution only costs you £80 in cash. The government then tops up the other 20%, and if you're a higher rate taxpayer, you can claim back a further 20% through your tax return. So that same £100 contribution effectively costs you £60, and for additional rate taxpayers, it drops to £55. That's an immediate return before the actual investment has done anything at all. One critical rule to remember here, you cannot access your pension before the age of 55, and that rises to 57 in 2028 and may rise in the future. One critical rule to remember here, you cannot access your pension before the age of 55. That's rising to 57 in 2028 and will rise further in the future. So if you need this money in the next few years, a pension may not be the right place for it. This is not an instant access savings account, this is for the long term. The annual allowance. Each tax year, you can contribute up to £60,000 into your pension. After this point, there's a clawback mechanism through the tax system. There's three important rules or traps here. Firstly, if your income is very high, we're talking adjusted income above £260,000, and your allowance starts to taper down. For every £2 over that threshold, you will lose £1 of allowance, though you can always pay £10,000 into a pension, even if you have more than the £360,000 of income. This is called the tapered annual allowance. If you're in that bracket, you likely need independent financial advice rather than a free YouTube video. The second trap, employer contributions count toward that £60,000 total. So if your employer is putting in £10,000 a year, you've only got £50,000 of personal contribution space remaining, not the full 60,000. It's worth checking your payslip if you're trying to max it out. The third trap, you can only contribute up to the higher of 3,600 or your actual earned income in the tax year. So if you're taking a career break this year, or your income is unusually low, or maybe made up from property or other unearned income, then your contribution limit may be lower than you think. The pension carry forward. It's somewhat of an edge case, but if you haven't used your full allowance in the previous 3 tax years, then you can carry that unused allowance forward and use it this year, on top of this year's £60,000. So if you've not contributed much historically, you might have a significantly larger allowance this year than you realise. The rules are a bit fiddly. You need to have been a member of a registered pension scheme in those years, and you use the current year's allowance first, but it can make a very large difference, particularly if you've had a windfall, like an inheritance or having sold a business, or just had a particularly good year. The lifetime allowance. You may have heard about the lifetime allowance, a cap on the total amount you could build up in pensions before facing a tax penalty. The good news is that the lifetime allowance was effectively abolished in April 2024, so the old concern about hitting the limit is largely gone. What hasn't gone away is the tax-free lump sum, the 25% that you can take out of your pension in retirement entirely free of tax, and the piece that turns deferred tax into tax savings. This is capped at just under 270,000, as it is linked to the old lifetime allowance, and that's regardless of how large your pension pot grows. One more powerful use of pensions: if you contribute to a pension, it doesn't just shelter the money from tax, it also reduces your taxable income for other purposes, which we'll come back to later when we're talking about the cliff edges at £50,000 and £100,000. This is one of the reasons that pensions are so versatile. Gift aid. Pensions get all the headlines, but gift aid quietly offers many of the same benefits if you're already inclined to donate to a good cause. When you make a donation to a registered charity through gift aid, the charity can claim basic rate tax relief on top, so an £80 donation from you becomes £100 for the charity. And again, if you're a higher or additional rate taxpayer, you can also claim back the difference between the basic rate you've already claimed and your marginal rate. So an £80 donation out of your pocket only costs you an effective £60 if you're a higher rate taxpayer, and the charity still gets £100. Everyone wins. The other reason that this matters is that gift aid donations extend your basic rate band, which means they can bring your taxable income down for the purposes of those cliff edges that we've mentioned earlier. If you're sitting just above 50,000 or 100,000, a meaningful gift aid donation could pull you back under the line. The catch is, you need to have paid enough tax to cover the amount the charity is claiming, and you need to actually claim it. It doesn't happen automatically. Higher rate taxpayers need to put it on their self-assessment return. ISAs. Okay, now let's talk about ISAs, individual savings accounts, which are probably the most widely used tax wrapper in the UK. The key difference from pensions is this: ISA contributions are made from post-tax income. You don't get tax relief on the way in, but in exchange, everything inside the ISA, growth, interest, dividends, is completely tax-free forever, and you can take it out whenever you want with no tax consequences. A couple of tax consequences. The annual allowance is £20,000 per person, and that's spread over the different ISA types. Unlike pensions, there is no carried forward. If you don't use it this tax year, then it's gone, and that's why the end of the tax year matters. The different types of ISA. A cash ISA is straightforward. It's a savings account where the interest is tax-free. With saving rates, where they've been recently, this is more valuable than it used to be. A stocks and shares ISA holds investments, funds, shares, ETFs, and all the growth and income is sheltered from both capital gains and income tax. For long-term investing, this is the one most people should be prioritising. You also have the lifetime ISA, or LISA, which is a mess of different principles, which is why it's so powerful, and one reason why the government is planning to remove these in the near future. The LISA gives you 25% government bonus on contributions up to £4,000 a year. So you put in £4,000, the government adds £1,000, and that bonus effectively represents basic rate tax relief, which makes it feel a bit like a pension in that regard. But, and here's the oddity, the underlying money is already post-tax, so you've had no relief on the way in, and you won't be taxed on the way out either. The 25% is a bonus, effectively, a gift, for using the right tax wrapper. The catch here is access. You can only use a LISA without penalty for either buying your first home or after you have turned 60. If you withdraw it for any other reason, there's a 25% penalty, and that applies to the whole amount, including the bonus, which means you actually end up worse off than if you'd never put the money into the LISA. So it's a wrapper for people who are confident about what the money is for. There are also age limits. You must be under 40 to open a LISA, and contributions must stop at 50. There's another real world note here. There have been discussions about withdrawing the LISA product altogether, so if you think you want one, then this window is limited. It probably closes next year. If you're eligible and interested, it's worth subscribing sooner rather than later. There's also an innovative finance ISA, which holds peer-to-peer loans and private credit instruments. These can offer higher headline yields than cash ISAs, but you're taking on real credit risk here, both borrower defaults and an illiquid product, and with no FSCS protection. The upside is capped in the way that debt returns always are. It exists, it has its fans, but this ISA is not for most people. Junior ISA. If you're looking to combine a bit of inheritance tax planning at the same time, then the Junior ISA is worth knowing about. You can save up to £9,000 per year for a child in a Junior ISA, which they have access to at 18. It's worth knowing about, but it's probably not part of the usual year-end tax planning exercise. Business profits planning. If you're self-employed or run a limited company, there's a few more levers available to you. For sole traders, the end of the tax year is a good moment to think about timing. If you're expecting to see a large item for equipment or other business expenditure, then bringing that purchase forward into this tax year can reduce this year's tax profitability. Similarly, if you have some flexibility over when you recognise income, then deferring that into the next tax year can reduce this year's liability. This does have to be genuine. For example, a builder delaying work by a week and taking a week's holiday, rather than just invoicing a month after the work is done. For limited companies, the single most effective thing a company can do is make a pension contribution on behalf of a director or employee. It's deductible for corporation tax, it doesn't attract national insurance, and it's not treated as income for the recipient. It goes directly into their pension. If you run a company, this is almost always more efficient than paying yourself a bonus. It's also worth looking at what income you draw from the company. If you're not using your basic rate band fully, then you can take some extra income. For the most part, you may pay basic rates tax a year earlier, but it may be able to avoid some higher rate tax in a few years as a result. R&D tax credits. If your business has been doing work that could qualify as research and development, and the definition is broader than most people think, you may be able to claim additional tax relief or a cash credit. The critical point here is that by the time we're approaching April, the work needs to have already have happened. But if you've done qualifying activity this year and haven't thought about R&D credits, it is worth looking into. An accountant can help you assess whether what you've been doing qualifies. A quick note here, R&D scams have been on the rise in recent years, so do make sure that the professional you're speaking to is well regarded. If you hold property in your own name, there's probably not a lot of last-minute tax planning available, maybe replacement of some white goods or furniture, similar to the capex we discussed for businesses more generally. And actually, you probably want that expense next year, as the tax rate is going to be higher, meaning you'll get a slightly better cash return. One note while we're here, though, is about mortgage deductibility. Mortgage interest deductibility was phased out a few years ago and was replaced with a basic rate tax credit. There are some long-term planning elements here, but that is too large a topic to tackle right now. The main thing to note is that your accounting profit, net of mortgage interest, may be substantially different to your taxable profit, which excludes it, and this can put you into a different tax bracket from the one you expect to be in. Venture capital trusts and enterprise investment schemes. These are in a substantially different category from everything else that we've discussed. They're higher risk, they're more complex, they do have very generous tax reliefs attached. A venture capital trust, or VCT, invests in smaller early-stage companies. In exchange for the illiquidity and risk, you'll get a 30% income tax relief on investments, up to £200,000 per year, tax-free dividends and no capital gains on disposal, as long as you hold for at least 5 years. The Enterprise Investment Scheme and Seed Enterprise Investment Scheme are similar in spirit. You invest in qualifying early-stage companies by subscribing for shares, which reminds me, do like and subscribe to the channel, and receive substantial tax reliefs. SEIS offers 50% income tax relief. EIS offers 30%. Both offer CGT deferral or relief in various forms. These are not mainstream tools and not for the layperson. The underlying companies can, and often do, fail. The tax relief cushions the loss, but it does not eliminate it, and the products themselves can be expensive and hard to evaluate. As I say, these are not for most people, and if you're looking to invest in an EIS for the tax advantages, you're probably doing it wrong, letting the tax tail wag the investment dog. If you don't have substantial pension, ISA holdings already, then this is not for you. If you're still looking at these as options, get an advisor. You will need more tailored advice than a YouTube video can give you. Tax loss harvesting. This one costs nothing except for time and attention. If you hold investments out of an ISA or pension in a general investment account, and some of those investments are sitting at a loss, you can sell them before 5th of April to crystallise that loss. That loss can then be offset against any capital gains that you've made elsewhere, either this year or carried forward to offset future gains. The thing to watch out for here is the bed and breakfast rule. You can't simply sell and then immediately rebuy the same asset and claim the loss. You'll either need to wait 30 days, buy through a spouse, or rebuy within a ISA or pension, which we'll mention again in a minute. The flip side here is crystallising gains. If you have unrealised gains and you haven't used your annual exempt amount, you might want to sell before the 5th of April to make use of it. The CGT annual exempt amount has now dropped to just £3,000, a fraction of the £12,300 that it was 3 years ago. So this is less generous than it was, but it is still free, and if you don't use it, then it disappears. The same bed and breakfasting rules apply for the gains. Using your zero rate bands. Related to the above, the tax system has a number of allowances and zero rate bands that simply aren't used by many people who are entitled to them. Capital gains, for example, as we just mentioned, the first £3,000 of gains per year is tax-free. You need to use this by crystallising the assets or lose it. One powerful technique here is spousal transfers. If you're married or in a civil partnership, transfers between you and your spouse are free of capital gains tax. They happen at a no gain, no loss basis. That means if one of you has used up your CGT annual exempt amount, you can transfer assets to the other and use their allowance instead. You effectively double your tax-free band. Similarly, if one partner is a lower rate taxpayer, there are income shifting strategies worth considering. Interest income. There's a personal savings allowance, £1,000 for basic rate taxpayers, £500 for higher rate, and unfortunately nothing for additional rate taxpayers. With savings rates where they are, this gets breached fairly easily, so knowing where you stand is worth it. The aim here is to not pay interest by coming in under the threshold rather than aiming for the threshold. Dividends. There's a dividend allowance of £500 per year, down from the £2,000 it was at just a couple of years ago. If you hold dividend-paying shares outside of an ISA, then even modest holdings can generate a tax bill now that would not have existed before. Again, this is a target to stay below rather than a target to use. It will keep your tax low and it lowers the need to report to HMRC via a self-assessment tax return. Luckily, by putting money into ISAs, both interest and dividends are likely to be able to come down. This system punishes the business owner who will take dividends, but not put someone who's investing in individual shares. The marriage allowance. One final option that's simple, free, and often missed. If one partner in a marriage or civil partnership earns below the personal allowance, currently £12,570, and the other is a basic rate taxpayer, then the lower earner can transfer £1,260 of their unused personal allowance to the higher earner. That can save around £252 in a tax year. It won't change anyone's life, but it is genuinely free money, and it can be backdated up to 4 years. A surprising number of people who qualify haven't necessarily claimed it. You can apply for this directly through HMRC or on your self-assessment tax return. There's no need to have an advisor for this. Part 2. When should I bother? Okay, so now we know what the options are, let's talk about why we would do any of this. Because the strongest motivation isn't abstract tax efficiency, it's something more concrete in terms of saving money. Use it or lose it. Let's start with the most basic reason. Some of these allowances simply expire. Your ISA allowance is the clearest example here. On April 6th, a new tax year begins, you get a fresh ISA allowance of £20,000. But the £20,000 from this year, it is gone. You cannot save your ISA allowance for later. Pension allowances are a little bit more forgiving. You can carry them forward 3 years, as we've discussed, but that carry forward only goes for 3 years, so allowances from 4 years ago are now lost, and if you plan to use carry forward, you need to have been in a pension scheme during those years. The zero rate bands. The CGT exempt amount, the dividend allowance, the personal savings allowance, these don't carry forward either. You need to use them this year or they are wasted. And there's a longer term point making here. These allowances have been shrinking. The CGT exempt amount was £12,000 3 years ago. It's now £3,000. The dividend allowance has gone from £5,000 to £500. There's no guarantee these won't shrink further. By making use of them now, restructuring holdings into ISAs, crystallising gains, you lock in the benefit before the window narrows further. However, if you're unlikely to use your full bands next year, there is limited point really in maximising your usage this year. You're sacrificing utility and flexibility of having that money accessible. This is more true with pensions and stocks and shares ISAs, but you give up very little if you put your money into an instant access cash ISA. Cliff edge tax bands. This is where, if you're lucky or unlucky, you can make big gains for small investments. The UK tax system is, broadly speaking, progressive. You earn more money, you fall into a higher rate band. But there are a few points in the income scale where it becomes dramatically and almost brutally non-linear. These are the points where small differences in income have large consequences, and where reducing your income by even a small amount can make an enormous practical difference. The £60,000 income mark and high income child benefit charge. If you or your partner claim child benefit and either of you earns over £60,000, you start to pay back a portion of that benefit through your tax return. By £80,000, you've paid it all back, meaning child benefit effectively becomes zero. If you're earning between £60,000 and £80,000 and you're in this position, every pound of income reduction, whether through a pension contribution or a gift aid donation, will save you both tax and restore some of your child benefit. The effective marginal rate in that band can exceed 60% when you factor this in, so this makes reducing income very attractive. The £100,000 tax trap. A hidden rate change and potential benefit withdrawal. This next one can be near catastrophic if you get caught by it, but it's also one of the easier traps to avoid if you have the time and the knowledge. Above £100,000, your personal allowance, the first £12,570 of income on which you pay no tax, starts to be withdrawn. For every £2 you earn above £100,000, you lose £1 of personal allowance. By £125,140, it's gone entirely. What this means is that income earned between £100,000 and £125,000 is effectively taxed at 60%, 40% of income tax plus the equivalent of another 20% from losing the allowance. That's the highest marginal rate the UK tax system has, if you're not looking at those multiple rules interacting with each other anyway. That's the highest marginal rate the UK tax system has, without looking at multiple rates interacting with each other anyway. And there's another consequence of being above £100,000 of income. You lose access to free childcare hours. Most people are entitled to 15 hours of free nursery care for all children and 30 hours for 3 and 4 year olds. If either parent earns over £100,000, you lose these entitlements immediately. There's no taper, no stages, it's gone all in one go. In some parts of the country, that's worth thousands of pounds a year per child. If you bring your income below £100,000 through pension contributions, gift aid, or other means, you can restore your personal allowance and your childcare entitlement simultaneously. For someone with young children earning £105,000, contributing £5,000 into a pension could be worth far more than just the tax relief. Higher rate and property finance. If you're a higher rate taxpayer and you own property with a mortgage, you'll know that you can't deduct your mortgage interest as a full expense anymore. You'll only get basic rate credit. You'll only get a credit at the basic rate. There's not a lot to do about this at year end, but if your income is borderline between basic and higher rate, reducing it below the higher rate threshold restores the effective full value of that relief. Saving in an efficient way. The last reason to act is the most straightforward. Even setting aside all the cliff edges and expiring allowance, there's just a smart order of priority for where to put your money. If you know you're saving £5,000 for the long term, you can get more bang for your buck if you take advantage of those various reliefs. Here are a couple of simple rules to remember. If you're a higher or additional rate taxpayer and you don't need access to the money for a long time, then pension contributions probably beat ISAs. The upfront tax relief is very valuable here. If you're a basic rate taxpayer and you're saving for a first time or long-term retirement and you're under 40, then a LISA beats a standard ISA. The 25% bonus is equivalent to getting the same tax relief as a pension, which basic rate taxpayers don't get from pension contributions. If you need access to the money, or might do, then not a pension, full stop. The access restrictions are real and they matter. If you already have a large pension and no ISA, or vice versa, then diversification does have value. Different wrappers have different access rules, different tax treatment in retirement, different inheritance implications. Having a meaningful amount in both is usually better than fully concentrating everything into just one of the wrappers. And of course, exceptions exist. Employer contributions on pensions, either through auto-enrolment or an employer-specific scheme, is essentially free money and should always be captured, though that's one to take advantage of through the year rather than as a last-minute tidy-up. Some people have defined benefit pensions that change the calculation. Some have pensions with protected benefits that make the decision more complex. The framework is a starting point, not a prescription. Do always consider your own circumstances. There are also ways to combine different elements that can be very powerful. For example, the so-called BED and ISA. BED and ISA is the informal name for selling holdings from a general investment account and immediately rebuying them inside of an ISA. You crystallise any gain or loss in the process, and from that point forward, all future growth is sheltered. This can accomplish multiple objectives. Number one, it uses up your ISA allowance, £20,000 a year. Number two, it may trigger a CGT liability if you have gains, and so you can mop this up with your annual allowance. Number three, you can maximise what you're moving by tax loss harvesting at the same time. Number four, it gets around the 30-day bed and breakfast rule. The gains and losses crystallise and remain crystallised despite you buying them back inside the tax wrapper. If you have a meaningful general investment account and you're planning to hold these investments long term anyway, systematically moving them so that the future income and gains are tax-free is very effective long-term planning, even if it takes a number of years to get there. There are other hybrid methods that you can use. The bed and pension, the bed and spouse. If you have any others, do leave a note in the comments to help other watchers. And a couple of final thoughts to leave you with. Firstly, there are no perfect answers in tax planning. We can only optimise with the information we have at the time. We don't know what our income will be next year, what the rules will look like in 5 years, or what the markets will do. All you can do is make reasonable decisions based on your situation today. And reasonable decisions, consistently made, add up to a lot over time. Second, and I want to be direct about this is not the time to be doing this, not in the last week of March. Every year platforms get overwhelmed, people rush, mistakes get made, and sometimes things just don't go through in time. If you're watching this close to the deadline, do what you can, but make a note for next year. The better habit is to start the tax year with a plan. If you're doing your 25-26 year now, then as soon as you're done, start working out what 26-27 looks like, what your targets are, and what allowances you want to use. Then let's check in around October to see where you are, and make any final adjustments in February or March. It's much easier to find the cash to implement that plan over the course of a year, rather than just a few weeks. Tax planning is not a once-a-year scramble. If done well, it's a steady rhythm that quietly saves you money every single year, without drama, without complexity, and without missing the deadlines. Finally, if you found this useful and want a tax guide on any other tax elements, then leave a comment and I'll see what I can do. Thanks for watching.